Imagine a tech company keeping like over 95% of its clients, boasting near 80% gross margins, and then suddenly watching its stock just crash 24% overnight.
Yeah, it's a completely jarring visual.
Right. Today is August 7, 2026, and that is exactly the scenario playing out with Trade Desk right now. I mean, Wall Street is basically declaring its core business model broken.
Well, what's fascinating here is that it's a phenomenal contradiction in the market. You have these incredibly resilient historical operating metrics,
And
right?
those numbers usually mean stability.
Exactly. But they're colliding head-on with this sudden, violent repricing of the company's future. Wall Street isn't just reacting to a soft quarter here. They are looking at a potentially permanent structural shift in how the internet is monetized.
So our goal in this deep dive is to synthesize a fresh stack of equity research and post-earnings analysis that dropped today. We need to figure out what this means for you, the listener.
Right, because an 80% drop from a 52-week high is massive.
It is. Is this a generational buying opportunity for a misunderstood titan? Or, are we watching the slow unraveling of an independent ad tech leader?
Yeah.
Because the numbers in this Q2 earnings print, they're just jarring when you look at the chronological trend.
Oh, totally. The panic makes a lot more sense once you actually map out that trajectory. I mean, you really can't look at Q2 in a vacuum.
No, you can't. So let's trace that line. A year ago, back in the spring of 2025, Trade Desk was putting up top-line revenue growth of 25% year over year.
Which is fantastic.
Yeah, in a maturing digital ad market, 25% is a premium growth rate. It justifies a premium valuation. But then we get to Q1 of this year, 2026.
Right. The deceleration.
Exactly. Revenue hits $689 million, but the growth rate slows to 12%. Now, it's a drop, but the market often forgives that if management can point to, like, a temporary macro headwind.
Which is exactly what CEO Jeff Green attempted to do. He pointed to macroeconomic pressures, execution issues, but then the Q2 numbers arrived.
And the macro narrative just started to fracture completely.
Yeah, it totally fell apart.
The Q2 print completely upended the story. They brought in $715 million, which missed the Wall Street consensus of $752.6 million.
Ouch.
But the really alarming figure is that year-over-year growth rate. It collapsed to just 3%. Going from 25% to 12 to 3 in consecutive quarters, I mean, that is a brutal trajectory for a company priced for hypergrowth.
It is brutal. But what really broke the valuation model wasn't the 3% historical growth. It was actually the forward guidance.
Right, because markets are always looking for it.
Exactly. Management guided for approximately $650 million in revenue for Q3 of 2026.
That is the number that completely stops me in my tracks. They just generated $715 million in Q2. And they're projecting $650 million for Q3.
Yeah, it's a huge red flag.
It's a 19.2% miss on estimates, but more importantly, it's a sequential decline in revenue. I really have to push back on Jeff Green's claim that this is just a cyclical bump in the road.
Right. You just don't see sequential revenue declines in a SaaS-like platform model unless something is fundamentally breaking under the hood.
Exactly. It's like a race car that didn't just ease off the gas, but actively threw the engine in reverse.
Yeah, I tend to agree, mostly because that sequential drop contradicts the very metrics Trade Desk historically uses to prove its dominance.
And this is the central paradox I'm struggling with. The underlying financial health metrics in this research still look bulletproof on the surface,
They really do.
Gross margins are sitting at 77.83%, net margins are over 14%, and most critically, their customer retention in Q1 was over 95%.
Right.
So put yourself in the shoes of an equity analyst here. How do you reconcile a platform that is keeping 95% of its clients with a revenue stream that is suddenly shrinking sequentially?
Well, you reconcile it by understanding that in programmatic advertising, keeping an account active and keeping a client's budget are two very different things.
Oh, that's a crucial distinction.
Yeah, a 95% retention rate just means clients aren't deleting their Trade Desk accounts. It definitely doesn't mean they're funding them at the same level.
So the money is moving somewhere else.
Exactly. To understand why those dollars are evaporating while the accounts stay open, we really have to look outside the company at the evolving structure of the digital ad market itself.
Right, which points us straight to the Morningstar downgrade in the research. They took an absolute hammer to Trade Desk's economic moat, downgrading it to none.
Yeah, none is a heavy word in equity research.
It is. For a company that effectively built and ruled the open internet's demand-side infrastructure, slapping a none on their economic moat is a massive philosophical shift.
It really is. And Morningstar's rationale focuses on the sheer gravity of what the industry calls walled gardens.
The big tech ecosystems.
Right. For years, Trade Desk thrived by being the independent, objective aggregator of the open internet. They were the alternative to Google and Facebook. But the landscape has shifted, and Amazon is aggressively encroaching on Trade Desk's traditional territory.
Let's break down the mechanics of why Amazon is such a lethal threat here. From what the research shows, it's all about their retail media network and the proprietary data they own.
Yeah, the data is the key.
Trade Desk operates on the open web, right?
Mhm.
Meaning they have to rely on complex algorithms and fragmented data signals just to figure out if an ad actually led to a purchase.
Exactly, but Amazon doesn't have to guess. They own the entire loop.
Because they have all the user data natively.
Right. They know what you search for, they know your purchase history, they literally have your credit card on file, and they control the checkout page.
It's all in one place.
Yep. So when an advertiser spends money on Amazon's platform, the return on investment is immediately measurable and undeniable. It is a completely closed loop.
I like to think about the analogy of trying to sell a product. Trade Desk's model is like buying up dozens of billboards along this intricate network of local highways.
Okay, I see where you're going with this.
You hope the right person drives by, sees the billboard, remembers the product, drives to a store, and buys it. It requires a whole lot of triangulation to prove the billboard actually worked.
Right, it's inefficient.
But Amazon and Meta, on the other hand, have built massive, self-contained mega malls. The user is already in the mall with their wallet out looking at products.
And if you are a media buyer managing, say, $1 million ad budget, you are inherently drawn to the mega mall.
It's just easier.
Exactly. Advertisers want outcome-based, low-touch optimization tools, which is exactly what the research notes Google, Meta, and AppLovin are providing right now.
They're building walled gardens.
Yes. They are offering simplified ecosystems that combine the user data, the ad inventory, the measurement, and the optimization all into a single dashboard.
Which introduces massive friction for Trade Desk. Because while Amazon and Meta are simplifying the process, the research points out that Trade Desk is actively battling its own clients over the complexity and transparency of its platform.
Yeah, this is a critical internal headwind. The report details a very public, ongoing dispute with Publicis, which is one of the largest advertising agency groups in the entire world.
That is not a client you want to be fighting with.
Definitely not. And the core issue revolves around Trade Desk's opaque fee structure.
Let's unpack the mechanics of those opaque fees. I think it explains the revenue drop. In the programmatic ad supply chain, you have the demand side, that's Trade Desk, and you have the supply side, the publishers.
Right.
When an agency like Publicis spends $1, they want to know exactly how much of that dollar actually reaches the publisher and how much is being skimmed off the top by the ad tech platforms in the middle.
Yeah, the industry calls that the take rate. And as budgets tighten up, major agencies are engaging in supply path optimization.
Meaning they want to cut the fat.
Exactly. They are demanding radical transparency. They want to strip out any intermediaries that are hiding their margins. So when a major platform like Trade Desk relies on a fee structure that clients perceive as opaque, it completely fractures trust.
Oh, wow. And that solves the retention paradox we discussed earlier.
You see it now, right?
Yeah. Publicis isn't going to completely delete their Trade Desk account. They have way too much historical data and too many legacy campaigns tied up there.
Exactly.
So the retention metric stays at 95%.
Mm-hmm.
But when it comes time to allocate new budgets, they quietly route those dollars to competing demand-side platforms, or they just hand it directly to Amazon.
Yep. The account stays open, but the revenue just bleeds out. A survey by William Blair in Q1 confirmed this exact dynamic, actually.
What did they find?
Well, digital advertising buyers reported that Trade Desk has been actively losing market share, and they anticipate the trend continuing. It's a slow, quiet attrition.
Which is terrifying for investors.
Yeah. And it's exactly why William Blair downgraded the stock to market perform.
So if clients are shifting budgets because they can't trust the fee structure, and competitors are offering a simpler, closed-loop alternative, well, Wall Street's brutal reaction makes total sense.
It really does.
I mean, the technical damage we're looking at is historic for this stock.
Yeah.
It last traded at $17.67. It's down 50.1% year-to-date and 80.7% off its 52-week high of $91.45.
We are witnessing a complete regime change in the valuation here. Historically, Trade Desk traded at massive premium multiples because everyone viewed it as the inevitable winner of the open internet.
Right.
But today, it's trading at 6.4 times 2026 EBITDA, which is actually below the broader sector average of 7.9 times.
And every major analyst is capitulating. 13 different analysts revised their earnings estimates downward.
That's a huge consensus shift.
Oppenheimer completely removed their $35 price target and downgraded them. Morningstar slashed their fair value estimate down to $29. The news sentiment is just uniformly bearish.
But this brings us to a massive contradiction in the data.
Oh, here's where it gets really interesting.
Right. While the analysts are running for the exits, the people who actually see Trade Desk's internal real-time dashboard are doing the exact opposite. If we connect this to the bigger picture, you have to watch what people do, not just what they say.
You're talking about the sentiment paradox,
Yeah.
the insider buying.
Exactly. Over the last 90 days, corporate insiders at Trade Desk bought a net 430,809 shares.
Wait, really? Nearly 500,000 shares?
Yes. You have nearly 500,000 shares accumulated by insiders right in the teeth of a catastrophic slide in the stock price.
But the breakdown of those transactions tells a much more nuanced story than just a simple wave of insider buying. The net volume is overwhelmingly positive, sure, but when you look at the individual trades, there were only 11 buy transactions compared to 23 sell transactions.
Yeah, and it forces a real debate about the psychology inside the C-suite.
I look at 11 buys versus 23 sells, and to me that signals a few high-level executives making massive, concentrated bets, while a much larger number of rank-and-file insiders are quietly liquidating their positions.
Yeah.
That doesn't exactly scream uniform confidence across the organization,
No, it implies conviction at the very top, but caution everywhere else.
Definitely.
The executives buying these massive blocks might genuinely believe CEO Jeff Green's narrative that this is just a cyclical macroeconomic issue. If they believe growth will return to 25% next year, then buying at $17 is the trade of a decade.
Because at a price-to-earnings ratio of 19.36, the stock is cheaper than it has ever been in its history. I mean, this is a company that routinely commanded a 50, 60, or even 80 PE multiple.
Sure, but you have to weigh that against the 23 sell transactions. Those sellers are looking at the same Q3 guidance of a sequential decline to $650 million.
They see the writing on the wall.
Right. They understand that a 19 PE is only cheap if the earnings is actually growing.
Exactly.
If revenue continues to shrink, margins will eventually compress, earnings will drop, and suddenly that 19 PE becomes a 30 PE without the stock price ever moving.
Which is the classic definition of a value trap. It looks like a massive margin of safety because it's down 80%, but the fundamentals are deteriorating so quickly that the stock is actually fairly valued, or maybe even still overvalued.
Yeah, so to determine whether it's a value trap or a generational buying opportunity, we have to look past the current quarter. We have to analyze their actual path forward.
So what are the catalysts that can actually arrest this slide? What can save them?
Well, the primary technological catalyst they are relying on right now is Kokai, their new AI-driven platform.
The AI Hail Mary.
Exactly. Kokai is essentially their answer to the walled gardens. Trade Desk realizes that human media buyers cannot manually optimize campaigns fast enough to compete with Meta or Amazon's automated algorithms.
It's just too complex.
Right. So Kokai uses artificial intelligence to analyze trillions of data points across the open internet, aiming to bid on ad inventory with the same level of precision and return on investment that a closed-loop system offers.
Okay, so to justify its premium and its complexity against Google and Meta, Trade Desk has to prove that Kokai actually delivers measurable ROI improvements for advertisers.
Yes, they have to prove that Kokai can find a customer on a random independent website just as effectively as Amazon can find them when they are actively searching for a product.
That is an incredibly high bar. They are essentially trying to replicate the efficiency of a mega mall using only highway billboards.
It is a massive challenge, and they need to prove it immediately because the market's patience is totally gone. The ultimate proving ground will be the Q3 earnings print this coming November.
Yeah, November 2026 is going to be a do-or-die event for this stock. They set the guidance bar incredibly low at $650 million. They have to beat that number.
They do.
But more importantly, they have to project sequential growth for Q4. If they guide for anything less than a return to growth in Q4, the market will just assume the deceleration is permanent.
True, though they do have some external tailwinds that could provide a temporary lift in the back half of the year.
Like what?
Well, historically, Q4 brings strong holiday seasonality, which naturally forces brands to increase ad spend.
Makes sense.
Furthermore, 2026 is a midterm election year in the US, so we should see a massive influx of political advertising dollars flowing through programmatic channels.
Okay, but those are just cyclical band-aids.
Mhm.
A spike in political ad spend doesn't solve the structural problem of Amazon's retail media network, and it certainly doesn't fix the opaque fee dispute with publicists.
No, it doesn't.
Even if they hit their Q3 numbers and get a holiday bump, there is a much larger, almost existential threat highlighted by the analyst desk at Jefferies.
Yeah, this raises an important question. The Jeffries note cuts to the absolute core of the issue. They explicitly state that the competitive pressures are stickier than management's cyclical narrative.
The deeper rot?
Exactly. And they point to a massive long-term risk that sits entirely outside of Trade Desk's control, which is the structural decline of open web publisher traffic.
We really need to unpack the mechanics of this because the decline of the open web alters the entire foundation of independent ad tech.
It really does.
Trade Desk doesn't own any consumer-facing websites. They don't own a search engine. They don't own a social media feed. They rely entirely on independent publishers creating content that attracts human eyeballs.
Right. Think about the evolution of the internet over the last few years. User behavior is migrating away from clicking links and visiting independent domains.
Right. Nobody clicks anymore.
We are moving into an era of zero-click searches and AI-generated answers. If a user asks a question and an AI chatbot provides the complete answer directly in the search interface, that user never clicks through to the underlying website.
So the publisher never gets the traffic. And if the publisher doesn't get the traffic, they have no ad impressions to sell on Trade Desk's platform. The actual digital real estate where Trade Desk operates is physically shrinking.
Precisely. Add to that the fact that consumers are spending the vast majority of their digital lives inside closed social media ecosystems or streaming platforms that have their own proprietary ad solutions.
So no amount of AI optimization from Kokai can solve a fundamental lack of human eyeballs on the open web.
Exactly.
If the audience isn't there, the advertisers won't spend money there.
This is why the repricing of the stock is so violent. The market isn't just worried about a bad quarter. They're worried that Trade Desk's total addressable market is structurally contracting.
So what does this all mean for you, the listener? Let's synthesize all of this. The core tension we are looking at is genuinely fascinating.
It's a great case study.
On one side of the ledger, you have Trade Desk trading at a historic discount, down over 80%. They still maintain 95% account retention and operate with nearly 78% gross margins.
Right.
And you have massive concentrated insider buying from executives who likely believe the CEO's narrative that this is just a temporary cyclical downturn. If they are right and Kokai AI re-accelerates growth, buying below $20 is a massive opportunity.
But, on the other side of the ledger, you have a company facing an absolute onslaught from trillion-dollar tech giants who are building highly efficient, closed-loop, walled gardens.
The mega malls.
Exactly. You have major agency clients actively shifting budgets away due to opaque fee structures. You have an unprecedented sequential decline in revenue guidance. And hanging over all of it is the structural decline of the open web itself.
They are threading an incredibly narrow needle right now. They have to repair client trust, prove their AI can match Amazon's retail data, and navigate a contracting open internet, all while facing intense scrutiny heading into a do-or-die Q3 earnings report.
It really forces a fundamental reassessment of what the internet will look like in the near future.
How so?
Well, the research points to the decline in open web publisher traffic as a headwind, but I think we have to take that thought to its logical extreme.
I love when we push these concepts to the edge. What's the ultimate scenario you're thinking of?
Well, if you look at the rapid deployment of AI-generated answers and highly personalized, closed-off digital environments, the open web is facing an existential crisis. So, if the internet fundamentally transitions into a series of AI-driven walled gardens where traditional websites simply no longer receive organic traffic, does independent ad tech even have a product to sell in 5 years? Regardless of how sophisticated Trade Desk's algorithm becomes, if the open web disappears, do they just disappear with it?
That is a staggering thought for anyone trying to build a long-term valuation model for this company. Having the most advanced programmatic bidding algorithm in the world doesn't matter if the digital real estate it bids on ceases to exist.
Exactly.
We will definitely be watching that Q3 print in November very closely. Thank you for joining us on this deep dive into the underlying mechanics of Trade Desk's collapse. Keep questioning the consensus, keep exploring on your own, and we'll see you next time.